Drew Meredith. How you doing?
Good to be here as always. I've got to open up with a laugh, don't I?
Yeah, you do. You laugh too much.
Wouldn't be me if I wasn't laughing straight up.
Yeah. You get a bit of feedback on that, don't you?
It's not one of my own jokes for one, so what can I say?
Yeah.
Amazing week. We missed you last week.
Yeah, I was sick. No, I was interstate, mate.
And sick. I started to get there too.
Yeah.
Go get your flu backs.
You were at the ASA. How was that?
It was good. It was a FIFO situation.
Yeah.
Flew in late Monday, did a session on Tuesday, and flew back out Tuesday afternoon. Dropped into lunch at the
Rockpool, I'm guessing.
Toddy's.
Oh, classic.
It was a sunny day, so
Sydney siders will
caught
get
up with a friend quickly.
Upmarket Italian, let's put it that way.
Apparently quite
served with a side of Botox.
I'm not going to comment on that. Apparently quite a good, from all reports, a fairly good session. It did make it easy for us though. So Jamie, my business partner, and I presented a session together. We came almost the first session in the morning, but before us was a virtual session. When we walked in, there were about 400 charts being shown and no human face.
Yep.
So it kind of made it easy for us to follow.
Yep.
And then followed up by the ASIC, the corporate regulator, coming in. So I'm not sure if our session was that good per se, as what we were sandwiched between was helpful to
Well,
how
if you
people
do
thought.
want to look good, just be between terrible things.
Yeah, exactly.
Yeah. That's cool. That's
And
great.
we tried to bring some props, so try to get the sentiment on various issues. So Trump is a thumbs down. Yeah, Elon Musk a double thumbs down.
Really?
At one point, the crowd was booing the photos we were putting up.
Really?
Yeah, we gave them tools to do it, but they weren't too keen on using the tools. Just prefer to use vote with their mouths.
You know who else loves props is Marcus Padley.
Yeah, it does. Oh, damn it.
He used to, I've still got some. Thanks, Marcus. I got some pens with lights on the end. Yeah, they're cool. Sorry, go on. You were saying?
Amazing. No, we did a session on, which is something you probably talk about all the time, the financial planning process, which is very difficult to do in a presentation, but centered around this idea of known knowns and unknowns.
Well, Inception. You just spent my mind
Donald
inside
Rumsfeld
out.
quote. It was like we were just putting financial planning into work by saying, right, we know we're all going to die one day, but we don't know when that's going to be. And as a result, we have to plan for multiple outcomes. We can't just plan for one. So it's kind of introducing these concepts to people that we know exist, but we don't necessarily think about deeply when we're building our investment portfolios. And
you said FIFO, which normally stands for fly in, fly out in WA, but also in the accounting world or in the Chartered Financial Analyst designation, that can stand for first in, first out. Yeah. So you were the first in the morning and then
first out. Straight after the session.
Where'd that drill guy go?
Signed a couple of books and got out of there.
Yeah. I heard that you were signing books. Yeah, there was a little, the canary in the coal mine was telling me that.
There was only one. Only one person asked for a signed book.
And it was just the books. It wasn't signing anything else.
Yeah.
So Xero delivered results. Headline says FY25. 23% revenue growth and 44% rule of 40. I love how they interpret that rule of 40 to be not 40.
40% earnings growth, yeah.
So
share price pop too.
Yeah, share price is
3%.
Popping. Revenue, operating revenue, 2.1 billion, up 23%. Subscribers up 6% to 4.4 million. Which in net subscriber number terms, which is a better way to look at it rather than percentages because your brain will go to mush, is 254,000 net subscribers. Now that's down from 419,000. We've spoken about this on the show before. Xero is the accounting software, makes subscriptions and bookkeepers and accountants absolutely froth Xero. Even if you don't have an accountant or a bookkeeper, you can use Xero yourself. It's that good. Help you manage your company affairs and whatever. And interestingly, like Sundar Singh Cassidy is the new, I think I've got that right. I can't remember it's off the top of my head. It's the new CEO. But interestingly, there's been a change of strategy at Xero over the last couple of years, which has just been growth in absolute terms will slow, but they have this, my thesis for the last 10 years with Xero. And the reason I held shares for so long, Drew, is because I believe that they can extract more value from existing customers, which indeed they are doing. And that has been reflected in the average revenue per user. So ARPU, average revenue per user, was up 15% to $45 per user. So that's up from $39. simplistic terms, you can get more subscribers, but then if you get them all to pay a little bit more, even if it's $1 extra a month, multiplied by 4.4 million subscribers paying an extra $1 a month, $12 a year, that's a lot of money.
Like Netflix.
And that's why you're starting to see things like their EBITDA. Remember when people said Xero wasn't profitable?
Yeah.
Well, now it's just made $640 million of EBITDA.
Once it gets there, it just pumps it out usually.
Yeah.
And the customers are once you start using Xero, like I'm a Luddite when it comes to like accounting, but Xero is like the easiest platform to use. It's not sponsored by Xero.
Yeah, Xero.
No
it's not
offense to
sponsored.
the other ones.
Xero, pull your finger out.
But
72% operating margin.
That can be why these things trade on a
ratio.
PE ratio.
Yeah.
The PE ratio on Google is 138 times. The actual forward PE ratio is probably going to be something significantly lower. But it can trade on that because your margin is what, 70%?
Yeah. Well, it's 89.
Your growth
is
is
90% profit
30%.
margin. Yeah, it's crazy.
And that drops really quickly.
So you're growing subscribers, 254,000 a year. Their lifetime value is $17.9 billion overall, so it's a lot in individual client terms. You're charging more, they're staying for longer, and like 90% subscribers, 90% retention is like, no, 90% retention. 90% gross profit margin is like the secret sauce there. Retention's like huge. So absolutely wonderful business. If you had to choose, Drew, between Xero and WiseTech over a 5-year period,
oh, you're going to get me again. We seem to have skipped over one important thing.
We'll come back to that.
But I will take Xero.
Xero.
Yeah.
Okay.
Hey, Google.
Why is that? Why not WiseTech?
I mean, WiseTech
What's your
feels a bit
beef?
narrow. And, high level
Narrow.
issues, sentiment can turn pretty quickly, similar to like a Tesla.
Interesting.
But that was also turned. And Xero is it's only scratching the surface in like 2 or 3 countries. And as you've said, the margins are there, the growth's there.
Yeah.
Significant opportunity.
Speaking of sentiment turning on Tesla, you may remember the three $10,000 fake money portfolios that we've been putting together.
Thanks to skip over it.
Tracked by Navexa, get your tax reporting and your performance reporting via navexa.com. That's built by Navar. He's in the office today, actually. So there's 3 portfolios. There's a community portfolio called Dizzy Rascals. This is the best one. Which is mine, which is definitely not the best one.
Yes.
Damn it. And Everything by the Honourable Drew Meredith. So let's start in reverse order. Coming in last, me, 2.56% total return negative. Negator.
What's happening with GGUS?
GGUS is, it's audacious.
Volatility decay?
It's not even volatility decay. It's just a
Decay.
crap pick. So that's down to 12%. Like an anchor on the portfolio, my equal weight portfolio. Also, likewise, equal weight portfolio is my micro cap, which is XRF Scientific, down 17%. I don't have much hope for XRF turning it around before the end of the year. I'm not much of an inter-year trader, but if I was guessing, I would say there's hope for GGUS. Because it is over 2 times levered, if the S&P 500 simply returns 5% from here, it will break even before the end of the year.
Yeah.
Minus
It's just rallied a
decay.
lot and it still hasn't done it. So
yeah, it's negative 12. Such is life.
What if breadth increases in the S&P 500 and
the mid caps?
Yeah.
Well, maybe.
Mid caps outperform.
You never know. Everything portfolio up.
What a week.
Up a nice 0.18%. That's total return for anyone living at home. 0.2% total return for the year. You must be stoked.
Incredibly stoked.
5 months in.
Been pushed by Tesla, 40% rally. And I think we've talked about that before. Everyone hates Elon Musk at the moment.
Yep.
Maybe not everyone, but a lot of people.
There's some people in Germany.
That means sentiment turns heavily against this business and heavily for this business quite quickly. And 40% in a month. And NVIDIA, the chip maker, up 23% in a month as well.
Yeah, so that's only down 3% for you. Tesla's still plumbing 17% down.
All that has to do is break even and I'll be up 30%.
Yeah, you'll be looking good. You'll be looking right. Dizzy Rascals is winning, up 1% at the time of recording, led by CBA, up 12%, followed by Solpats, which is basically identical, just under 12%. Also, Vulcan weighing on the portfolio, which has been a shocker from the get-go, and KKR like a brick.
Still don't know how that thing snuck in there, to be honest.
Vulcan.
Yeah.
Well, I just wanted to make sure the community portfolio didn't
Lost.
win. I took some of the crazies from the community and thought, that's a good one. Go with that one. No, but seriously, there was a bit of rally behind Vulcan being a lithium producer. Another one that's performing reasonably well is, what's this? The Fairlight Asset Management Fund, which is a global small and mid-cap fund. That's growing pretty well, up 3%. ASML up 7% listed there. I don't know. I didn't realize it was on the NASDAQ. I think it's the ADR. That's okay. Moving on. What else is making news?
I think that's one part, which is the rally that's turned around in a very short period of time. And I think we saw a theme throughout all of those portfolios that semiconductors are taking off again.
Yeah. Risk on, baby.
Yeah, very much out of favour. And I mean, it's come, I'm not sure if you've been watching the news this week. I
China.
do not watch the news, but
You don't?
reading the news.
Yeah.
Very rarely watch the news. I might listen to an international podcast that gives me a bit of an update, or read the Fin and a couple of other publications. But Trump doing deals.
He's wheeling and dealing.
That's what he's good at.
Brinksmanship.
It's like he was planning this all along.
Yeah.
Too late, pal. What does he call? Someone said he tweeted 45 times overnight.
Did he really?
I don't even know how that's even possible. Made a deal with China. That's where a big chunk of this rally's been. And
90-day terms
you
or
must
something?
be still happy with your $100,000 purchase.
Yeah, I haven't
at
even
the
checked in
bottom.
on that. Jesus Christ. Let me have a look at this.
But made deals with China, and then he's gone into the Middle East and basically trying to get $1 trillion in commitments of investments to US companies in the US economy. And he's, I mean, for all accounts, we know Twiggy did do this with, wasn't it, with renewable energy during the pandemic? Not comparing the two, but obviously you get signed on the dotted line, and then you actually have to see the money flow at some point as well. But super interesting. Like, I think it was Qatar agreed to buy hundreds of Boeing aircraft. You had an agreement to buy Raytheon, whatever they do, drone defense technology. So heaps of deals around defense, around aircrafts, around technology, basically. I think a couple of big agreements with Saudi companies to provide chips for their data centers as well. Wasn't
there a deal that like the Qatar royal family was going to give Trump a new Air Force One?
Yeah, temporary.
And then it was due to expire 2 weeks after his presidency finishes, and then it goes to the Trump Library Foundation or something. But I was thinking about this. Like, if you're like the president of the United States, sure you don't get in some Middle Eastern pimped out luxury plane. Like, surely there's some sort of like security issues. Like, who knows what's inside that plane? You know what I mean?
Coke and hamburgers.
There could be anything in there. There could be listening devices. I don't know. I don't want to be a conspiracy theorist.
I feel like Trump doesn't hide very much anyway. He's always tweeting, and then someone put, a journalist into the WhatsApp group talking about defense policy. So
yeah, true.
It's almost like an open. What have I got to hide? He does.
True.
They
did use WhatsApp to then plan that military thing, and that was a bit shocking, to be honest.
Yeah.
But anyway, okay. So Trump's trying to rally the troops, literally, getting free planes.
22% gain, I think, in the S&P since the bottom. So back from a bear market into a bull market quite quickly.
Yeah, well, interestingly, I don't have live data on this, but I think I'm only up like 8 or 9% on my 100K drop in, which, I mean, it's better than a kick in the nuts.
The S&P?
No, I bought our diversified portfolio, so I bought Martian.
Oh, I thought you were just buying the market.
No.
Yeah.
I hate being like diversified.
Hindsight.
I'm kidding. Where am I? So that's like 30% Aussie equities, 42% international. There's a question on this in a minute, so we can get to that. But yeah.
Macquarie got sued.
Yep, by ASIC. I saw that.
Yeah, not reporting short selling. CBA.
What do you mean not reporting short selling? What does that mean?
Apparently they didn't appropriately report short selling of securities that the Macquarie Securities Group, not Macquarie broadly, Macquarie Securities, had not been appropriately reporting their short selling activities, whether that's for them or someone else, for 15 years. So it's more one of those systemic things where something
no one notices
wasn't
until
set
they
up with
notice.
their reporting yet. And CBA, like how this thing,
just a gift that just keeps on
like
giving.
A lightning rod for everyone. It's overvalued, sell it. It's undervalued, buy it. Never buy it. It's too expensive. Most expensive bank in the world. Stories could go on. It's $1.45 short of its 52-week high, which I believe is also its all-time high.
So, sorry, just untangle that language for me. So it's $1.45 off its all-time high.
Yeah.
Yeah, we're back, baby. Markets are back.
And despite every day articles every day about how overvalued it is, Interestingly, probably good for us. Massive growth in CBA's business banking division. So 9.1% growth in the quarter for business lending. Profit, I think cash profit was up 6%. And that's it's 30% faster than the rest of the industry, the banking industry.
They always use this terminology of system growth, which I've always been like spooked by that because I'm like, if you're growing so much faster than everyone else, why?
Usually
what are you doing?
You're just better at it.
But then who are you? Like I can understand you growing consistently a little bit faster, but if you're growing so much faster, what are the other guys not offering that you can offer?
Well, you go back to I think 3 or 4 years ago, and the problem was like ANZ and a couple of other banks were struggling to actually get applications through their process. Their technology was so far behind that there were delays, and that's why they couldn't lend as much. Whereas most of like CBA has one of the most, same as Macquarie. I bank with Macquarie. It's like the most efficient lending. They want to give you that money. It's just how quickly can we do it? Once you've been certified as someone that they're willing to lend to.
You got to be credit worthy, as they say. It's interesting. I won't say who, but I know that some of the banks are still running on MS-DOS. Like this is not a joke. Like they are legitimately
Python.
They wish are running on MS-DOS.
What is MS-DOS? Is it like
it's like the old black and white screens? You know, like when you used
to. But why do you use that for? Is that to like search your customer base or something?
That's still
when it
literally for
comes
everything
up on the screen and it's like name. Yeah.
And they would like check customer records. They'll write loan applications. Like they're literally coding into MS-DOS. If anyone that's ever done this will know, it's like a black screen with white text.
Yeah, I think you can bring it up on. How do you bring it up on your computer?
Yeah, you can. It's terminal on Mac.
Terminal,
terminal on Mac. Yeah, that's what it looks like. And that's like, I don't even know when that was invented. So but versus CBA and Macquarie that are using like AI and all this type of crazy shit.
All your loans are done by email, by DocuSign.
Yeah.
Or some even more advanced version of DocuSign.
So that's no wonder that they're growing faster. It's interesting about business banking. We still use NAB. I'm open to it, but I like NAB.
Also got the $3 million super tax making headlines today.
Yeah, that's going to be, it's going to be really, it's going to sting you. I saw Jamie was in the Fin review saying something along the lines of, which is great for Jamie. He was saying something along the lines of, because Jamie's a younger fella. He's not like retired or anything, but he was like, I'm going to hit the $3 million cap.
Yeah.
And it's just about dealing with it. It is what it is. And so be it.
Yeah.
Is that the super tax you're referring to?
Yeah, exactly. I saw, it's just when you open the Fin this morning, and I love the Fin by all means. But
Drew is always happy for a quote financial review or an expose or whatever you need.
Expose, no, thank you. SMSF, here's the headline.
Step aside, Chris
can
Joy.
sell assets to avoid Labor's $3 million super tax. Macquarie's, no, that's the wrong one. Think twice about trying to avoid the $3 million super tax. Chalmers defiant as pressure builds on $3 million super tax. On the front page, there's 4 mentions of the $3 million super tax in that tiny amount of valuable space.
Yeah, the Greens are pushing for a $2 million super tax.
Yeah. And
neither of them are indexed. So that would be an absolute thank you very much.
The concern there, and we're pretty vocal on it, is it aims to and will tax you on unrealized capital gains. So it looks at the value of your super and how much it's gone up over that $3 million, once you're over that $3 million threshold, and taxes you on the difference in the value, not even if you haven't sold anything. That's the biggest concern that people have.
It's similar to land tax for people that need a kind of like similarity. It's like you get taxed even though you haven't done anything.
Yeah.
And that's probably the bit that really spooks people, because then they're like, well, if you're doing it to super, what else are you going to do it to?
Exactly. Slippery slope.
I think that, to be honest, my opinion on this is like the $3 million is fine as long as it's indexed.
Yeah.
Because then it's kind of future-proof.
Which is not.
Yeah, because then in 5 years, someone that's got $3 million won't be nearly as wealthy as someone that's got $3 million today. So as long as it's indexed, I think it's okay, because a lot of people know that super is very tax advantaged.
Yeah.
But if you've got $3 million in super, start building wealth outside of super.
We did an episode.
We already had the balance transfer cap.
Yeah.
So like the amount that you can switch to tax-free environment anyway. Anyway.
We did a good episode on the Australian Retirement Podcast, went deep on the $3 million cap and on the tax, and how many people are going to be impacted 5, 10, 15 years from now.
Is that out yet?
That one is, that would have come out earlier this year. We weren't sure what the election would look like back then.
Yeah.
And there's also a bonus ep coming out next week on the Australian Retirement Podcast, which looks at the super changes that are coming from 1 July. Not the made up ones that people said were coming on 1 June and were emailed around and put on
June?
YouTube. Yeah. That's the first giveaway. Did you hear about that?
No. What happened?
So basically, everyone got spammed with these emails. It had something like USA.org in the, first thing, and then 1 June. And it was spouting these massive changes to super that you get a bonus if you left money in accumulation longer. You could only take half of your balance as lump sums, and that the preservation age was going up to 70 from 60, all from 1 June. Generally, not generally, nothing changes in Australia on 1 June.
So whoever programmed those articles.
If you put 1 July, you probably would have got
would have got people.
Got traction.
Yeah.
But it's been everywhere.
Silly willies.
Yeah.
Okay. What else you got for us?
I did notice a question pop up from that retirement community too. You know, the 30-30-40 portfolio.
Go for it.
Came into my inbox. I always question this because I'm not sure many people actually implement a 40-60 portfolio that is 40% bonds, 60%
stocks,
straight equities.
Yeah.
But someone put a paper on there that talked about a more efficient portfolio being 30-30-40. So 30% alternatives, real assets, credit, 30%, I think it was equities, and 40% bonds.
Okay. What do you make of it? 30% alternatives. So there'd be like gold in there. There'd be like
private credit, unlisted assets, alternatives, private equity.
Yeah, all that stuff.
I think all these portfolios work well at different times, but no portfolio works perfectly forever. They're always delivered with an incredibly extensive white paper that makes assumptions to get to certain, modern portfolio theory makes assumptions as well. The key here is that I don't think any specific portfolio is suited to every person or every situation. I think it's good to encourage people to look at diversifying and finding resilience in different forms of income. It could be infrastructure, looking at the debt side of the balance sheet rather than the equity side, which we all focus on. So I think they're all positives, but thinking there's a 40-60 or a 30-30-40 or a 10-90 or something that by itself just solves everything, I think is the mistake that we commonly have.
Yeah, fair enough. I kind of agree. Final bit of news is Tencent. Let's bring in, this is the Australian Investors podcast, and over the next 10 years, we'll probably have more of a bias towards Chinese equities. What's going on with Tencent?
Might be time to add it back to the FANG.
You reckon?
Yeah, it got cut.
Because it got removed from FANG. A bunch of those.
They all got cut.
In the FANG ETF, there was a bunch of Chinese stocks that got removed, 3 years ago?
Yeah, they got a bit touchy.
One time Twitter was in there.
Yeah.
Anyway.
That got removed for another reason, I think.
GlobalX, sponsor of the show, by the way.
The Chinese tech sector is quietly having a bit of a renaissance this year. Just dropping a new word there.
Renaissance.
Yeah.
Zeitgeist. Renaissance, yeah.
We use that every week for the next few weeks now.
Yep.
So data centers, e-commerce, WeChat, I believe, social media,
massive gaming. Yeah.
And it's had a solid start to the year. I think it's up something like 15-20% so far this year. And it delivered a pretty big increase in revenue and a pretty good increase in profit too, 13% in both cases. And it joins things like Alibaba and a few other companies that are also posting good recoveries, which they say is kind of coming off the DeepSeek announcement and the increase in interest in Chinese tech again.
Yeah, it's I caught up with Billy Leung from GlobalX last week in Sydney, and we were talking about their new Dragon ETF, DRGN, I think it is, which has 20 Chinese stocks, 10 from the H shares, which is Hong Kong, and 10 of the A shares, which is mainland.
Yeah.
And it was really interesting the way he framed it, in that the Chinese market is going much like the Indian stock market, if you're familiar with that kind of renaissance. No, I'm kidding. With that kind of like growth through time, is those markets, those big developing markets, tend to stay closed to foreign investors for a very long time until the companies and the industry is matured enough, because the country, as they're emerging, tend to protect their capital markets from foreign influence. But China's now starting to open up its stock market, and you're starting to see that as part of their plans, obviously, the next century. You're starting to see more foreign investment into Chinese shares.
Yeah.
And in particular, Billy was talking about like these champions. So they have like national champion stocks. So that would be companies that we haven't really heard of in here in Australia. But then they only allow, this is the gist, right? Is that they only allow those kinds of companies to become available for foreign investors when they become global champions. So not just national champions, global champions. And they kind of approve them to be traded outside. And a good example of this would be like BYD. So BYD...
Top holding, yeah.
BYD is kind of like a business that is not just a Chinese winner, it's a global winner now.
Yeah.
Rivaling Tesla, if not better, right? And there are many instances like that, like Alibaba and other businesses that are not just winners in China, but are winners across the globe. So that's been a really interesting evolution. And I think investors should take notice of that over the next couple of decades. We do have some questions here, Drew, that we must get to. As always, we've got a bucket load of questions, like so, probably the most.
I thought the spreadsheet broke down last week.
So we're not going to have a chance to get through nearly all of them, but please keep sending them in because we'll be back next week. If you do have your question answered on the show, please remember it is general in nature. Our responses to your questions do not take into account your needs, goals, or objectives, so speak to a licensed financial advisor before you act on the information. If we do talk about things like ETFs or super funds, please remember that those things are called financial products and have a PDS or product disclosure statement. You should read that before you invest or use that super fund, for example. In particular with super, don't change until you've reviewed your insurance and spoken to your advisor. So you can find out more on the Rask, about the Rask Group at www.rask.com.au/FSG for financial services code. First question comes from Let's Get Fiscal, which is kind of a good bit of accountability to me. A lot of discussions lately on ETFs and their merits, some of which was generated by Owen. Late last year, there was talk around making imminent changes to the Rask core portfolios, which never eventuated. The change including adding either X20 or MVW in order to reduce weighted exposure to the banks and miners in the current portfolios. Wondering why the portfolio change have not already occurred given the high bank valuations and associated risks. We're recording this on Thursday, so 2 days' time, recording it Thursday Arvo. So it's the 17th. But on the 16th, you would have seen on our YouTube channel that we've just announced our new holdings. And indeed, we've made this switch. We did not use MVW. We've considered it. Did not use X20. We considered it. We did not use VSO. So one of the things, Drew, that we've been researching over the past year is that, yes, Australia has had a lot of exposure, like the market cap weighted index funds like VAS and...
You're coming to the dark side.
No, not quite. Let me explain. There is a lot of exposure in the index weighted ETFs to banks and resources. Resources haven't done that well, but banks like CommBank we just talked about has been just doing so well. So one of the things that we've done is we looked at the different ways to cut up the Australian market, and in particular, how can we get exposure to the midriff of Australian companies that are really good companies, but without the market cap weighting skew. So we had Stephen Bennett on the show from Invesco talk about this concept. But the problem that you have when you have a small cap ETF or a mid cap ETF, or even some ways an equal weight ETF, one of the problems that you have is that companies in there outgrow the ETF or they age out. So oftentimes...
Survivorship bias.
Yes. You'll have some ETFs rise to the top. So say you've got like VSO from Vanguard, where you get a company that's like 50th in that pool once you invest in it. It gets the 20th biggest in Australia. But because it doesn't include the top 20, once it goes from 20 to 19, it gets sold. But normally winners keep on winning. And what you instead get is you get the 20th that then drops to the 19th, that drops to the 20th, and you end up inheriting a loser and giving up a winner. That creates tax consequences, trading consequences. So ultimately, we went with a different ETF entirely. We actually blended in ATEC, which is the Australian all technology ETF from BetaShares. So this ETF just focuses on 5 key sectors: software, technology, Xero's in there, WiseTech's in there, computer shares in there, these types of businesses. And this is a very deliberate, some might say active exposure, Drew. It's not an active strategy, it's a rules-based strategy, but it blends in really well with VAS, which we still hold.
Just equals out your sector weightings.
Exactly. Yeah. And it gives us, it nudges our midriff towards technology. Midriff. There's kind of mid-cap weighted stocks, not the ones at the top, not the ones at the bottom, the ones in the middle.
It gets rid of that underweighting to tech, which is like 4% of
the
index most of the time.
And we'll continue to expand that through time. Not that holding necessarily, but that's one of the big things. So we have made the change.
And a smaller holding?
Yeah. Depending on the model that you choose, it could be anywhere from 2.5 up to 10% in the extreme case. Soon, we hope that our investors will be able to determine some of their own weightings within their allocations as well.
Yeah, amazing. I think one thing I always say there is that you say that given high bank valuations and associated risks, I mean, this all comes down to what you perceive as risk. If you think risk is underperforming the index, well, an ETF might be all you need. But if you think risk is, making bad decisions when the market falls or outliving your capital, then that requires a different approach. I think I'm always wary of people just saying bank valuations as high, let's sell them. We don't want them. They can remain high for as long as longer than we remain solvent.
Our mate Warren often talks about this. He often says that, like, what's the business that wouldn't go bankrupt? It's a bank, like a big systemically important bank.
And they tried.
It doesn't mean that you will make money on them, but it does mean that they are systemically important to the whole of society. And so people always say that about Commonwealth Bank. I don't think I've had a day in my career where I haven't heard someone saying Commonwealth Bank's overvalued. I'm not saying that's a good investment. I'm just saying, like, there's been a lot of quantitative easing money and a lot of superannuation money flowing into CBA. This is not from our podcast, but I wanted to ask it to you because I had no idea. Drew, what does it mean to know the cost of opening your front door? That's from Doors Plus. What does it mean to know the cost of opening your front door?
How much your lifestyle costs on a weekly basis. Yeah. As soon as you leave the house, you're spending money. You start to think about ching. Is that what it means?
I'm guessing what it means is, can you please write into us and correct us? What does it mean to know the cost of opening your front door? I think we're both assuming that it means the cost of just getting up.
Yeah.
Yeah. Don't know. It's from Doors Plus. So it's a good question.
3 hours sleep.
We don't know the answer to it.
Doors Plus. No. Is that what it is?
Yeah, that's used. Is that like is that trademark?
Yeah.
Sorry.
Send me a letter.
We've probably got time for one more quick question. And apologies that we have to be a bit quick today. I don't like that we have to be quick. Okay. Baron Buffet, which I think would be Warren Buffet, says, as a married couple, this is a good one for you, how much should we be focusing on who is investing? I'm thinking due to my wife earning substantially less, being part-time, whilst looking after our child. So the question is, effectively, Drew, how do you think about like tax file numbers, incomes and that sort of thing when who holds the investments?
I mean, there's a tendency to think short-term on this. And, the best bang for buck, would probably be if your wife's working less or not working for a period of time, it would make sense to put investments in her name at the time.
Yep.
But we always suggest you've got to take a longer term, high level view when you're thinking about this because, and think about what your careers are and where your career trajectory, made a new word.
Yeah, it makes sense.
And what that looks like. Will the husband take time off? Is the wife in a high paying role and is just taking a short period of time off?
Yeah.
It's generally, it is simple to see who's earning more or less money at one point in time, but then other options come up, like you could hold it jointly. If you're both high income earners generally, then it could be worth using a family trust.
I was going to say that because then there's like childcare subsidies as well that may be impacted.
Yeah. And then you've got the flexibility to distribute to each other when your roles or your income change, or distribute to a corporate beneficiary from that family trust, which helps you cap your tax rate. So I think the answer to this would be,
it depends.
I haven't said that yet. One, it depends. What your circumstances are now, but also what they look like in 10 years. Don't trap yourself down a line where...
Yeah, it's so important.
And I see this quite often with property. So a lot of clients come in that have bought a property in their name or their spouse's name, and obviously difficult transfer, but then all the income and all the deductions are going to that person.
Yeah.
So try to think about it now and then the 5-10 years from now.
I like that answer. Yeah, really do. We do need to get a dad joke from you, Drew. While you're doing that...
a cracker this time.
Okay, I'm just going to quickly answer this question because it's more like a PSA, public service announcement, from Dodge Doe. Hey team, in a recent podcast, can't remember which one, Mr. Rask released equity in his home and bought $100K in a 50-50 portfolio. Can you talk a little about the reasons behind choosing the portfolio in terms of short and long-term thinking behind it, or the tax reasons? Thanks, Dodge Doe. So Dodge Doe... The reason, so we thought we were going to go with a 50-50 strategy, but we ended up going with a 70-30 strategy, so 70% growth, 30% defensive. And the reason is that the actual investment is held in a company structure. So we've got a private holding company. It's just set up, you pay $470 a year to ASIC. It's a company that exists to invest or loan money across to other entities. And so we call this a bucket company in financial planning. So what we wanted to do, one of the key tax considerations of a company to invest, so if a company opens an account and invests, is that it cannot claim the capital gains tax discount. So versus an individual, I won't go into it too detail, but basically what that means is we're trying to produce more income at over growth, not hugely biased one way or the other, but the key thing is here is that we want franking credits, we want income, and then we can pay tax and reinvest if we want to. Capital gains is great too, don't get me wrong. We're after total return, as Drew always says, but at the same time, if we have a conservative risk profile and we get generous income, happy to do that too. So it was a 70-30 portfolio. I think I did make a mistake on one of the posts where I said it was 50-50. I chose the 70-30. Drew, people can get financial advice through waterpartners.com.au. But they can't get dad jokes through waterpartners.com.au.
They can send them through, which is always helpful.
They can send them
through. They quite often do.
You need to give us one.
I had a great conversation with a dolphin the other day.
Okay.
We just clicked.
That's not bad, man.
I was going to try and make the noise. I'm not very good at those sort of things.
Maybe Adrian can put like a dolphin noise.
I was going to try to find on YouTube. I didn't think it would work. I'm a bit of a Luddite with this stuff. So.
Oh, mate, that's great. Well, this has been heaps of fun. I know you're getting a gazillion leads at Water Partners. Water Partners YouTube channel you're basically going to become an influencer next week. So, mate, we really appreciate you taking the time out to join us on the show.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.